Something important is shifting beneath the surface of the silver market, and it has very little to do with headlines coming out of New York or London. The real pressure is building quietly in Asia, where silver is not treated as a trading vehicle, but as a form of savings, protection, and industrial necessity. In India especially, rising incomes, persistent currency pressure, and deep cultural trust in precious metals are converging at the same time industrial demand is accelerating across Asia's manufacturing base. This demand is physical, price-insensitive, and increasingly impatient with paper promises. Unlike Western markets, where leverage and derivatives dominate price discovery, Asian buyers want delivery, not exposure, and that difference is becoming impossible to ignore as inventories thin and settlement risks rise. As this imbalance grows, the strain on Western paper markets becomes structural rather than cyclical. The COMEX and LBMA systems were designed for liquidity and confidence, not for sustained physical drawdowns. When large volumes of silver are removed from the global pool and shipped east, the paper market is left pricing a metal it no longer fully controls. Alasdair Macleod has repeatedly emphasized that this disconnect between paper claims and physical availability is the core vulnerability in the system, and silver, due to its smaller market size and heavier industrial usage, is where fractures appear first. By 2026, even modest increases in Asian demand could force cash settlement, repricing, or rule changes in Western exchanges, not because of speculation, but because the metal simply isn't there. What makes this moment different is timing. Asia's demand surge is colliding with years of underinvestment in mining, declining or grades, and governments prioritizing strategic stockpiles over open markets. Silver is being consumed, not hoarded, which means every ounce removed tightens the system further. If confidence in paper silver weakens at the same time physical premiums continue to rise in Asia and India, the market won't break loudly. It will fail quietly through delivery delays, backwardation, and sudden price gaps. By the time Western investors realize price discovery has migrated east, the reset may already be underway. Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
I think the thing to look at is the silver price in China. It's still well above here. Demand for silver is basically off the charts. And you've got two things now working for higher prices. The first is industrial demand. Bear in mind that India's industrial demand is increasing very, very rapidly. The second thing is that you have in Asia, if you like, a greater affinity with silver as metallic money than we do in the West. In the West, we see it as small change, silver coins, which are always fairly insignificant in terms of their value. But in Asia, it's a completely different story. China was on silver standard until 1935. And in the Middle East, when I first went to the Middle East, which was in the 1970s, Maria Theresa dollars were still circulating and being used as money, certainly in the Bedouin tribes and also, a bit more widely. So, they know that silver is money. We slightly dismiss it. And consequently, you've still got queues around the block for, silver bars, silver coin, whatever, throughout Asia. Now, we're talking about a very large proportion of the global population, if you like, going for it. So silver, if you look at the price in China, in Shanghai, I closed last night at something like 111, while here we were around about 80 or a bit less than 80. So you can see that there's a significant premium there. Our paper price hasn't caught up with the physical price. And I think that's the key thing to understand. So I think it's being drained out of Western markets. It will go back into China so long as there is the arbitrage. There are costs involved in arbitrage, obviously. But I can't see how the Chinese banks with branches in London will just sit on their hands and say, well, there's no silver in London. We won't bother. No, there is an arbitrage opportunity. And I think They'll probably take it on Globex anyway, the international version of the COMEX. I think that's the basis of it. I think the other thing to bear in mind is that if you look at the value of base metals measured in gold, because gold ran up quite strongly, it may be a bit ahead of the game in terms of the falling purchasing power of paper currencies, but nonetheless, it means that it has left behind base metals and other commodities, which basically is what the gold's value represents. And so I can see in 2026, I can see a substantial uplift in commodity prices measured in gold, and even more of an uplift in depreciating fiat currency values. So, that's going to give us, I think, a huge, great problem with inflation later on this year.
Yeah.
I mean, you can see the producer price index, I think you'll find that's really going to rise. I mean, we had a 3% rise overnight, but in America, but that's just the, hardly the start of it. I think there are going to be real problems on that front. And of course, as you get the falling purchasing power of the dollar, gold, silver, platinum group metals, copper will continue to rise and rise a lot more strongly than you think is likely. Well, the risks are definitely there. But I think we should bear in mind that the authorities are actually quite good at hiding these things. If someone gets into trouble, they will be bailed out and we won't know about it. I mean, there were all sorts of stories on this shakeout about how dealers were getting into trouble, therefore they manipulated the price down and all the rest of it. I mean, I don't think that's true. I think what we saw was something which was an opportunity by the swaps, by market makers, by bullion banks, basically to hit the expiry of the February contract at a time when China had packed up and gone home for the weekend. That's the time when they can just push the price anywhere they want. There's no speculative or very little speculative interest. I mean, this is an amazing thing. If you look at the commitment of traders figures, which separates out the managed money, in other words, hedge funds, and speculators in the other reported category. I mean, they weren't long. They really weren't long. And indeed, hedge funds have been selling gold down. It was only really in the last sort of week or so of, into mid-late January that they were actually increasing their position. So there were a few people to shake out, but not all that many. And, without any speculators in there, you're not going to get the sort of volumes, if you like, which, where you got people saying, okay, it's fallen so far, time to buy some sort of thing. They're just not interested. I think they're all scared stiff of what's going on or not understanding it. I mean, you would think that you would get momentum chasers in there, but they're hardly there. It's an extraordinary situation. The amount of speculative activity to shake out here has been virtually none, which really means, ironically, that, the swaps, the market makers, I mean, they could just mark things down as much as they want without really being challenged. And I think that's roughly what happened.
The shift that's quietly unfolding across Asia isn't about speculation anymore. It's about control and credibility, and gold sits at the center of it. Physical demand is no longer being driven by price dips or short-term trades, but by a deeper mistrust in Western financial plumbing where paper claims far outweigh deliverable metal. As capital moves east, gold is increasingly treated as a monetary anchor rather than a commodity, especially in regions where currency risk, geopolitical friction, and trade realignment are no longer theoretical. This is creating a structural bid that doesn't disappear when prices pull back, because the motivation isn't profit alone, it's protection. What makes this moment different is that Asian accumulation is colliding directly with a Western system built on leverage and synthetic exposure. The paper market was designed for liquidity and price management, not for mass physical delivery, and that imbalance becomes dangerous when enough buyers insist on real metal. Alasdair Macleod has repeatedly emphasized that gold is the pressure point in this system, because once confidence in paper settlement erodes, repricing is not gradual, it's abrupt. Gold doesn't need explosive demand to expose the gap. It only needs consistent, non-price sensitive buying that drains available supply while paper claims continue to expand. Looking into 2026, the real risk for Western markets isn't volatility, it's loss of narrative control. If gold continues migrating from financial instruments into sovereign reserves, vaults, and private hands across Asia, price discovery will slowly shift away from leveraged exchanges toward physical reality. That's when paper dominance weakens, not through collapse headlines, but through irrelevance. The question isn't whether gold will be revalued higher, but whether the existing system can survive a world where trust flows east and paper promises are no longer accepted as money.
I suppose in the fullness of time, we might see, some, if you like, sort of trade statistics. But I don't think that's really going to give us much of an indication. I mean, I don't think we need to try and examine this, to overthink it, to examine it too deeply. Just look at the premium in Shanghai compared with prices in the West. I think that's all you need to look at. And as long as the premiums are there, you can bet your bottom dollar that it's going to drag us up. And that's actually what's happening today. I mean, we've had a pretty good rally today. I mean, as we talk, I can just get my chart up. I mean, we're looking, silver is up 12%. I mean, gold is interesting because there isn't very much difference between the price on the Shanghai Gold Exchange and the spot price in London. There's not a lot of difference. And I noticed also that JP Morgan are now forecasting a price at the end of this year of over $6,000, which tells me that they've got an even to long book. So, I think that's the way of it. I think that they're probably more frightened of getting short in silver than they are gold. I mean, there is a bit of a flow in gold, and you can keep your position level. Perhaps when gold ran above $5,000 up to $5,500, there may have been some who found that they were net short. You're looking at positions across COMEX and London. And on that basis, they would have joined in, hitting the price, banging the price as much as possible to try and get some stock back. But there again, if you look at the contraction in open interest, I mean, it wasn't as much as you would think on a hit in the price of that magnitude. I mean, we know what's happening to gold. The managed money category are just not interested broadly. I suspect they're all chasing, tech stocks and things like that. Which is yesterday's story. And of course, the other thing is Bitcoin. There's some big losses beginning to emerge in Bitcoin. And I think if that falls, below the current levels by much, that is going to destabilize quite a lot of investors. Might even chase some money into the precious metals. I don't know, but that's something which will be interesting to watch. Well, debt is the underlying condition which always ends a fiat currency. And the way this one is going to play out, I mean, we can see it now. What will happen is that the US Treasury will have difficulty funding its debt because it's rolling over, I think, almost 1/3 of the total outstanding debt. Plus, of course, around about this year, we're looking at a further $2.5 trillion of deficit to finance at a time when foreign interest in US treasuries is declining. And that decline, I think, accelerated on the back of what happened with Venezuela and the saber rattling over Greenland. I think you'll find that foreigners will be less and less interested in buying US treasury debt. So what that will do is it'll drive up bond yields along the yield curve. We can then see that will pop the equity bubble. And you've got a situation where, last time I looked at it, there was $44 trillion of foreign investment in onshore US dollars. We're not talking about Eurodollar markets, which are offshore. That's another 13 trillion or so. I mean, 44 trillion. is a huge, huge number. And of that, something like 22, so, approximately half, maybe a bit more than half, is invested in equities. When you get a rise in bond yields and that upsets equity, the valuation for the equity market and generates a bear market, I think foreign investment in the US Treasuries is going to run for the exit. That will collapse virtually everything. So what does the Fed do? Well, the answer is the Fed and the US Treasury have a mandate, it's a very clear mandate, to support the banking system, to support businesses in trouble because they're over-leveraged in debt, and also, crucially, to support the stock market, because there is this belief that so long as Americans are making money in the stock market, they're all happy and everything's fine and they're all confident. I mean, that goes back to Greenspan. That was more or less what he said. So you can see what's going to trip the whole thing up. Now, the response basically to deal with all those issues will be a massive expansion of QE and interest rate suppression below where it would be. So what does that do to the dollar's value? It collapses it. So you can see how important this debt thing is just going to trigger the end of the fiat currency regime, which is led by the dollar, because once the dollar goes, the rest will go with it.
What's coming next will catch most market participants completely off guard, because the real shift isn't happening on trading screens. It's happening through steady, relentless physical accumulation across Asia. China and India are absorbing silver at a pace that has nothing to do with short-term price moves and everything to do with long-term strategy. This demand is structural, not speculative. It's tied to industrial expansion, energy transition infrastructure, and a growing distrust of Western financial plumbing. Every ounce pulled into long-term Asian hands is metal permanently removed from the pool that supports Western paper claims, and that drain is now becoming impossible to ignore. The danger point emerges when paper volume continues expanding while physical availability quietly contracts. On the surface, liquidity appears endless. Contracts roll, spreads tighten, and volatility is managed. But beneath that surface, the market's foundation is thinning. Delivery is no longer an abstract concept when buyers insist on metal in hand, not settlement excuses. As physical silver migrates east, the Western system is forced to rely on leverage, rehypothecation, and confidence rather than inventory. That works only until confidence cracks, and history shows it always cracks suddenly, not gradually. From here, the sequence is increasingly clear. Persistent Asian demand will collide with a paper structure built on assumptions that no longer hold. The next phase isn't driven by panic or headlines. It's driven by recognition that silver has been priced for a world that no longer exists. When that recognition spreads, repricing won't be orderly or polite. It will be abrupt and unforgiving. The only real question left is this: what happens to a paper market when the metal it depends on is no longer for sale? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.